Hey guys, what's going on? Welcome into the video. So in this week's video, we're going to be going over a few major patterns that are forming in the broad market and what to expect next from that. We'll then talk about some fundamental risks to the market moving forward, and then some major opportunities and catalysts to pay attention to in the week ahead. Let's go ahead and get on into it. So taking a look at the S&P index, the market has essentially two different modes that it trades in. So mode 1 is trend, which means that the market is either making clean moves to the upside or to the downside. It's a healthy trading environment. You can get clean moves on both sides. Breakouts and breakdowns also work well during this mode. So mode 2 is chop, which means that the market has very choppy price action. It is usually range bound and it continuously fails breakout and breakdown moves. This mode is the unideal trading environment. So this mode 2 action is what I've highlighted on the S&P chart and the mode that is currently in. Mode 2 price action is needed for mode 1 to start though, and the longer and tighter that the consolidation is equals the larger move that the trend will be after the chop phase is over. The SPY has closed between 394 and 403 for 11 consecutive trading days, building out one of the longest and tightest ranges that we've seen in all of 2022. So I'm thinking you guys know what is coming next, and that is of course the next big trend. Now saying this, I do not think they're going to make it simple this time around, and that's for a couple reasons. Number one is we have two major resistances right above this zone at the 200-day moving average currently at 404.8, and then the key trendline resistance at 408 to 409-ish on the SPY. So one very important thing to know is during bear market rallies, the market tries to trap as many participants as possible. Now in my opinion, what this would mean would be a break over both of these key resistance levels, make everyone think that the bottom is in, get a bunch of bottom callers and saying we're going back to new highs, and then dump the crap out of the market after hitting around 411 on the SPY. Now, of course, I've said something like that is my base case, but it probably won't play out exactly like this. It could easily reject off the 200-day moving average, off of the trend line, or go a lot higher even before dumping, though I personally do not think that the market has bottomed for quite a few reasons that we've talked about on the channel. One big one, Morgan Stanley lays this out well. This chart is from Morgan Stanley Research, saying that given the 10-year real yield, the S&P 500 forward PE should be 13 in this environment in comparison to versus 18 where it is at now. Historically, as we can see, if the yield and the PE separate from each other, they revert back together not long afterwards. Essentially is saying that the S&P is way overpriced currently based on where yields are at. So unless the Fed fully pivots and cuts rates, valuations are not yet attractive. One other suspect thing is that analyst estimates are likely way too high for earnings next year if we are headed into a recession, which does look likely currently. Earnings growth could easily be negative next year if so. And look, I hate being bearish on the market, but I am a trader more than anything. I'm happy to trade the upside as opportunities arise, and same for the downside, which at the end of the day currently, I do think there is going to be a big opportunity to trade the downside soon enough, but of course would only wait for confirmation from the technical setup to do so. Now taking a quick look at the shorter term technicals on the S&P Futures chart, it is currently in this uptrending channel off of lows. To keep it simple, as long as trendline support of the channel holds up, bulls are in good shape, but if it breaks down, that is where things can get bearish once again. 40-50 is currently acting as strong resistance and top of the recent range. If it breaks above this, it can start the next short-term leg higher, with the next major spots that I have above are at 41.10, 41.50, and then 42.03 above there. I would not be surprised to see a scenario something like this, where it breaks out next, tests those upper key resistance spots before breaking back down. This would also line up with that scenario we talked about on the SPY chart, where it breaks above both that trend line and the 200-day moving average before the sell happens. It could even sell off earlier than this or go a lot higher before selling. My personal thoughts though is that this is an area to start being cautious where the market is at currently. Sure, we could easily go 2 to 5% higher or so in the short term, but the broader trend, risk reward, and technical setup favors a bearish move in the near future in my opinion. Alright, so now let's go over a few important market moving catalysts to pay attention to for the week ahead. Monday and Tuesday are relatively quiet, and then on Wednesday, the important one will be Powell speaking at 1:30 p.m. Eastern Time. So this speech is 2 days before the Fed's blackout period starts leading into December FOMC. So in other words, because we won't have Fed speakers for 2 weeks after next week, Powell is going to prep the market as much as possible ahead of the December 14th rate decision and likely leave a bunch of important hints in his speech. A common theme this year has been Powell talks the market down whenever it is headed higher, because markets going up creates a wealth effect, which creates higher demand and spending, which equals inflation taking longer to come down. Now this speech could give us some different signals than that we've seen before, but for now definitely look at this as a major volatility event and possible risk to the market moving forward into this week. On Thursday, the most important catalyst is core PCE, which is a measure of prices people pay for goods and services. This is one of the data points that the Fed has talked about they take most into account with their decisions. So the current estimate for this is 0.5% year over year. Bulls want to see this come in lower than expectations to work as another positive catalyst for the market. And then on Friday, the important one is non-farm payrolls, which comes in an hour before market open. For this to be a positive catalyst, bulls want this number to come in below the 261,000 estimated. We want to see that job numbers are headed down, aka lower jobs equals the Fed tightening job is working, and then inflation effects will follow after that. This number has consistently came in above estimates this year, so if we saw a number below, that would be a big step forward for the market. But of course, nobody knows these numbers until they come out, so stay cautious, of course, when going into major events and volatility like this. Now let's take a look at a few more super important charts for the broad market moving forward. First up, the VIX is one of the most important indicators for the stock market. It is a measure of volatility, and many call it the fear indicator because when market volatility goes up, stocks go down. The VIX is now oversold on the daily chart for the first time in years, which indicates a balance will likely come next. Along with this chart is a comparison of the current VIX in white versus the VIX during the 2008 crash. Now, I'm certainly not saying this is going to follow this and rocket up to 80 next, but what this does show is just because the VIX has been relatively muted this entire year does not mean that pain cannot follow next. Will we see a geyser rocket move like we saw in 2008? Most likely not, but after multiple years of choppy consolidation for the VIX, this definitely has built up energy. If we got some type of major negative economic catalyst, the setup is there for this to take off, which is a major risk. And one more look here with the VIX compared to the S&P. As we can see, this current setup looks a lot like the rally that took place from June to August, where the S&P was set up in a rising wedge pattern on the way up and VIX in a falling wedge pattern on the way down. Once these patterns broke out, that is when the next leg down for the market started. Now, of course, it does not have to play out exactly like that again, but this is another chart that is currently screaming to be cautious right now. One more super important chart right now is with Apple. This is maybe the most important trend line in the stock market. So this is the trend line that is held as support all the way since July of 2020. And this could also be looked at as a massive long-term head and shoulders pattern that has been forming for 2+ years. And on the daily chart, we can also see a smaller time frame head and shoulders pattern building out right now. If Apple breaks down from this trend line, look out below, because as we know, if Apple goes, so does the market, and it will have a big domino effect if so. A similar setup that we talked about recently was with Tesla stock that looks super similar to the Apple technical setup we're seeing now. It was in a 2-year long head and shoulders pattern right above the long-term key trendline support, and once it broke, it had a 20% drop in a span of just a few weeks. So if that happens to Apple, which sure may not, but the potential is there with the technical setup that we are seeing, if that happens, the market could get ugly very quickly once again. So I hope you all enjoyed the video and I provided some value to you in this one. If so, make sure the like button and subscribe button helps me out a lot, and I would greatly appreciate that. For anybody interested in joining the private Discord chat, that is the first link down in the description to get my personal trade alerts. And I will catch you all next time. Good luck trading this week. Lots of important catalysts up ahead. Let's have a good one, and I will catch you all next time. Peace out.